This video presents how to calculate the internal rate of return using Excel function IRR. First we look at what is the concept of internal rate of return. The internal rate of return IRR is probably the most widely used sophisticated capital budgeting technique. IRR is the discount rate that equates the NPV of an investment opportunity with ₹0. It is the compound annual rate of return that a firm will earn. If the IRR of a project exceeds a company's required rate of return, the project is acceptable. If IRR falls below the required rate of return, the project should be rejected. NPV gives us whether the cash flows are positive or negative. That is, cash flows are greater than 0 or less than 0. So it gives the amount of a cash flows, whereas IRR gives the percentage of return on an investment. So IRR is more simple and easy to evaluate than NPV, because it simply says how much, what percentage of amount we are earning from an investment, and it is compared with our cost of capital. Suppose for cost of capital of a company is 15%, so we expect that the project should give us more returns than our cost of capital, that is more returns than 15%. So if it is 16%, 17%, then we may accept the project. So for our calculation, we make an assumption that the cost of capital of our project is 8%. So our cost of capital is 8%, and we are trying to evaluate two projects. One is project A and another is a project B. So here are the cash flows. Both the projects, we are making an investment of 5 lakhs and 5 lakhs. So here are a stream of cash flows. Okay. First we see what are the total cash flows from each project, equals to sum cash flows, cash inflows. So our cash inflows from project A is 6,50,000, and we look at what is about project B, equals to sum here also our cash flows are 6,50,000. Both the projects cash flows, that is non-discounted cash flows, are 6,50,000. But what happens with the discount cash flows? So while calculating NPV, we make a guess, we make an assumption with a discount rate, but here in case of an internal rate of a return, we don't have any rate to discount the cash flows, so we have to calculate the rate. Normally calculating this, what we do is we go on a trial and error method where we try to see that NPV equals to 0, that is net present value of a cash flows equals to 0. So we look at a lower rate, then higher rate, then lower rate, then higher rate. With so much of a trial and error, we calculate manually, but Excel built-in IRR function calculates that rate for you. So here we see how to calculate IRR using Excel function. This equals to IRR, then select the values including cash outflows. So here are our cash outflows and inflows, and it asking you to give the guess. So if you have any guess on what is the rate of return on this project, you can give, else ignore it. Excel will automatically calculate your IRR. So from this project, the IRR is 7.50. We look at project B. So here equals to IRR, select the cash flows including net outflows or net investment, and click enter. So IRR here is 8.27%. So our cost of capital is 8%. Now the decision will be made based on cost of capital. Our cost of capital is 8%, and this project B is giving us internal rate of return more than our cost of capital, that is 8.27%. So we accept project B instead of a project A, we accept project B.